Welcome back to our series on basic finance. Today we're going to be covering some concepts relating to financial statements. So what are financial statements? I like to think about financial statements as business stethoscopes or an instrument that we're using to measure the health of a company. Just like when you go to a doctor's office, they're going to take your blood pressure, check your heartbeat. Financial statements are like tools that we're going to use to measure how a company is performing. Financial statements are just simple records of a firm's financial activity. They record what we spend, what we take in for income, and where our money's at. We use financial statements to answer questions like how much money did a firm make? What liabilities does a company have? And how much cash does a firm have available? These are all questions that we can answer by looking at financial statements, and they'll actually tell us a lot more about a company, and we'll get into that in the next lesson. Two of the main financial statements that we're going to focus on are the balance sheet and the income statement. The balance sheet represents this equation: assets equals liabilities plus equity. Now, this is also sometimes referred to as the accounting equation, and it shows what a company has at a certain snapshot in time. So a balance sheet for December 30th is going to show all the assets a company has on December 30th, all the liabilities a company has on December 30th, and the equity that its shareholders have on December 30th. Assets are something we own. Think about a car, a building, maybe factory equipment. These are usually things that we buy. A liability is something that we owe. So think about a loan. Maybe someone has sold us products with the expectation that we pay later. That would be a liability. And equity is the value in owning part of a firm. So as shareholders in a firm, we have equity in the business. If we were to sell all of our assets and then pay off all of our liabilities, all the money left over that goes to the owners of the business would be the owner's equity. The income statement represents how much money we make. Income equals revenues minus expenses. So we take in money for the year, we spend money that year, and what's left over is our income. The income statement shows how much money was made in a given period of time. So sometimes income statements may be quarterly or yearly, and taxes are often included as an expense. We don't have to worry too much about actually making these statements because that's more the role of an accountant, but we're going to use these statements and we want to know how they function. There is a third financial statement called a cash flow statement, which shows us how our cash is moving around. Now, cash flow is different from a cash flow statement. Cash flow is how our money is going out of our business and how our money is coming into our business, and the statement is going to highlight all these different cash flows. There's cash flow from assets, so a firm is going to use assets, maybe factory equipment, to generate cash. Cash flow to creditors, paying off debt, so we're going to pay people who have loaned us money cash to pay off our debt with them. There's cash flow to stockholders. Sometimes we're going to pay dividends, and we're going to pay our stockholders cash. And there's operating cash flow. So this is the cash we get from producing things and selling them, normal business operations. Another concept to think about is short-term versus long-term. Typically, short-term is anything less than a year, and then long-term is going to be anything over a year. When it comes to assets, we have current assets. So a current asset is something that will be turned into cash in less than a year. So if we have inventory, we expect to sell that off within a year, and when we sell inventory, it turns into cash. Then we have fixed assets. These are long-term things. They're often pretty hard to convert to cash. If we have equipment, we'd have to sell it on some kind of open market to turn it into cash. Or if we have maybe a patent, we can't really sell our we can sell patents, but it'd be a lot harder to sell compared to a current asset. Liabilities also have short-term and long-term factors. So a current liability is something that we're going to pay off in less than a year. That would be like our accounts payable. So if someone has sold us product and we're paying later, we expect to pay that off usually within a year. Long-term liabilities are things that we pay off in full over a year. Think about a long-term loan, maybe a mortgage. That's often what these are. Current assets and current liabilities are going to be pretty related, and we're going to see that with our net working capital in a second. So looking at other terms, we have that net working capital. It's the amount of cash that will become available within the next year. So if we take our current assets minus our current liabilities, that is our net working capital. So we're going to make this much money in a year, we're going to spend this much money paying off debt in a year, and everything left over is our net working capital. If we're going to pay off more money in a year, or if we're going to use more cash in a year than we're going to have a negative net working capital, which means we're going to lose cash that year. There's this concept of liquidity. Liquidity is the speed at which we can turn something into cash. Cash is going to be the most liquid thing. We can spend it right away. But let's say we have something like a machine that we own. It's going to be a lot harder to turn that into cash. And let's say we have inventory. Well, the inventory is going to be a little bit easier to turn into cash because we can sell that pretty much right away. So cash is the most liquid. Inventory is something that's fairly liquid. And then long-term assets are not that liquid. There's this concept of financial leverage. If we have more debt, that means we have a greater financial leverage. Basically, we're playing a high-risk, high-reward game. We're using a lot of debt to fund a lot of different projects with the expectation that they will pay off. And then there's this concept of depreciation. An asset is going to be worth less over time. Think about something like a car. So when you own a car, your car is going to lose value pretty quickly over time. Most cars lose a lot of their value in the first 2 years that they're owned. Depreciation is a non-cash item, so it doesn't directly affect the amount of cash we have. Let's say we have $10,000 in our bank account and we own a car. The depreciation that car accrues over time, so the value that car loses, is not going to affect the amount of cash we have in a bank account. It is going to affect the value of our assets, but it's not going to directly affect our cash that we own. Some final terms to cover involve taxes. We have an average tax rate. So this is the percentage of your income that goes towards taxes. Think about, if you take what you pay to your state, what you pay to the federal government, and you divide that by your income, that's going to be your average tax rate. And then your marginal tax rate is how much more tax you would pay if you made more money. So if I make $1 extra, how much more of that is going to go towards taxes? I guess we have a progressive tax system in the U.S., so the more money you make, the higher a tax rate you're going to pay. So if we make a lot more money, we're going to start paying a lot more money, and that's where the marginal tax rate comes in. We don't have to worry too much about these. We won't use these too much, but it is just something to cover with the topic of financial statements. All right, and that's the end. Thank you for watching. Please check in next time, and we're going to get into some problems actually relating to financial statements, working out math problems that you're going to see on maybe homework assignments or tests. So thanks for watching. We'll see you next time.